All right, we are live. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob. I see you're at the stock exchange today.
I am. I got a little business to finish here, and we're sailing into the end of July. Market's doing very well, Katie. Up today, and up for the week, and up for the month, up for the year.
Yeah, well, let's talk about it. So, first up, Bob, what has been driving stocks higher recently?
Well, if you wanted to put it in one word, the soft landing has become consensus. So the rally is broadening out. So remember what happened earlier in the year. Basically, we kept talking about these 7 or 8 stocks that kept moving the market up. Microsoft and Apple, Nvidia. And all of this was about the AI revolution that was going to change everything. And the problem is that the initial idea was buy these companies because they're going to be the biggest beneficiaries. Now there's a lot of debate about how much is going to actually happen and whether there are other companies that would be beneficiaries. But in the meantime, the market's changed a little bit. So this month we've seen energy stocks move up nicely. Now oil is not far from $80. That's a big help, but that's a broadening of the market. Material stocks like Freeport-McMoRan, Mosaic have been moving up. Those are global names. A lot of industrials have been hitting new highs, like General Electric or Parker Hannifin, Ingersoll Rand, for example. Those are big global industrial names. That's a good sign. Not everything has been participating. The market's generally up, but consumer staple stocks have been Kimberly-Clark, Colgate, Clorox, generally are down this month. Some of these names had run up in prior years, rather notably, and some of them may have a little bit of pricing issues. These consumer names have been pushing price increases for a long time, like Hershey's. And I think the second half of the year, you're going to hear stories about pushback on the prices. So if you have less ability to raise prices, and costs are, still high, coming down, but still high, you're going to have cost cutting. You're going to see companies talking about cost cutting, margin pressures. I think this may be a story in the second half, but for right now, the S&P is up 19% this year after a 20% down year last year. Remember that, and we're up almost 3% this month. So there's a lot of positive momentum in the market right now.
So, Bob, on Wall Street, where does Wall Street stand on the soft landing debate?
Well, it's important to understand what the soft landing is. The soft landing is basically where the jobs market slows down, but does not crater. In other words, job growth is still there, but we've had exceptional job growth. We've had many, many more people available than for the jobs that are out there. And what the Fed wants is to slow that down. And so the soft landing will be still getting job growth, but doesn't crater, doesn't go negative, and where you get other things that are happening that are generally positive. So you would get the economy still holding in there. You particularly get interest rates stabilizing, which is very important. So generally, job growth slows down, but is still relatively strong. Stable interest rates, mortgage rates don't keep going up, for example. That's sort of the soft landing scenario. And so far, that has happened. Now, remember, that's different than earlier in the year. Earlier in the year, the markets were having issues and there was cuts in earnings because everyone was convinced there was going to be some kind of serious recession this year or late this year. And that has not happened. And essentially, the soft landing hypothesis is now sort of the prevailing hypothesis. And I always like to talk about the pain trade. The pain trade is what would cause the most discomfort to the most number of investors. In other words, where's everybody off sides? And the pain trade at the start of this year was the market would go up because a lot of people thought there was going to be a recession, the market would go down. So the pain trade, what caused everybody the most discomfort, would be the market would go up. And that's exactly what's happened. So now that the market's gone up, a lot of people have stopped being bearish and have become bullish. Now, the pain trade is the opposite. The pain trade is the market goes down and rates go up. That may be a source. And you saw yesterday when Rates on the 10-year went above 4%. That was a little bit of a problem. The market moved down on that. And there were various reasons. There was a Bank of Japan headline about, potentially higher rates in Japan or higher yields. And we had a lousy 7-year auction too. So all of a sudden, there's your pain trade. The pain trade is nobody thinks rates are going to go up, and rates go up. And I don't know if that happens or not. All I can tell you is I've been watching this pain trade story for 25 years. And once everybody gets too much on one side, the pain trade story becomes very real, because there's a likelihood that things will mean reversion, essentially. The market goes back. So right now we are basking in relatively stable interest rates, but you see what happens if they start pushing up a little bit. It raises the cost of everything. You don't want 30-year mortgages to go to 7 and 8%. You don't want that. It's just a problem. It slows down things a little too much. So this is what they talk about when they say Goldilocks. We just want things, we know they're going to be higher. We know rates are going to be higher, and they should be, but they don't have to get out of control. And that's why the market's been doing so well, because it's not out of control. Higher, but not out of control.
So, Bob, we had some big companies that reported earnings this week. I know we have another busy week ahead next week. How's earnings season going so far?
Short answer is good. So the second quarter is going to be the trough for earnings. So, analysts, big macro analysts, they track the S&P 500. What's the earnings trends for on aggregate, the 500 companies? And obviously, they don't all move in the same direction. But there is a general trend, and that's what people are watching. So generally, for total earnings, the second quarter is the trough. It's going to be down about 6% compared to the second quarter of last year. We do year-over-year comparisons. And, that's a pretty noticeable drop. It's not catastrophic. There have been drops of 25% during real recessions, but it's down. And this is probably the bottom. It's going to go up from here. Now, the question is, how much is it going to go up? So right now we have about half the companies reporting. About 250 of the 500 have reported second quarter earnings. About 80% are beating. That's a little better than normal. They're beating by about 6%, 7%. That's on the high end of typical numbers. Remember, these companies tend to try to play down the estimates, so they want to try to beat psychologically. This is a very well-known game. The question is, how much do they beat by? So everyone builds in a certain amount of expectations, and if you do even better than that, well, that's considered, a surprise. So generally, the numbers have been coming up on the slightly higher end of expectations. That's good. So the most important thing about these earnings stories, and I emphasize this to particularly younger investors, is it's the trend that matters. It doesn't matter what the reported number is. Second quarter reported numbers is in the past. We're in the third quarter. The stock market is a discounting mechanism for a future stream of earnings and dividends, which is distribution of earnings. That's what you get when you get a stock. You get a participation in the profits. That's why you own stocks to begin with. So the story here is investors pay a lot more attention to forward guidance and earnings calls, which is where they provide commentary on what they think. That's what matters to everyone, and that's what colors everyone's perception on the markets here. So what you need to ask yourself if you're an investor is, what is the earnings trend? Whether it's an individual company or Caterpillar or IBM or Apple, whatever, or if it's the overall market. Is the earnings trend up? Is it down? Is it sideways? And for the S&P 500, for the overall market right now, the earnings trend earlier this year was they were lowering estimates for 2023. Now, what's happened is the estimates have stopped coming down and they're stable. The second half estimates aren't changing much. They're down compared to they were in January, but they're stable. So the trend, and this is what's important, the trend is sort of sideways right now. And the expectations are earnings estimates are going to be higher in 2024. So the trend has gone from down to sideways, and who knows, in the next month or two, it could go back to going up again. So the trend going from down to sideways is an improvement, even though nobody's dramatically hiking estimates. So it's very important to get your head around that trend here. So The good news is we've stopped coming down in the second half of the year. Now, a lot of objections can be made about earnings. You can say we need earnings are just sideways, but prices are higher. How can that be? Well, what's happened is the multiple, the PE ratio, has expanded. So there's two components to this. One, when you're buying stocks, one is what's the earnings, the actual real dollar value of the earnings, and secondly is how much are you willing to pay for that. So you might get a stock that has $1 in earnings. Well, how much are you willing to pay for that dollar in earnings? We pay $10. That means you have a multiple of 10. Is the price of the stock 15? Means has a multiple of 15. How much are you willing to pay? And a lot of this depends upon what you think future streams of earnings are going to look like. Is that dollar going to turn into $1.10 and $1.20? So this is that what I mean. It's a constant game of trying to figure out what the future is going to look like, which turns out to be extremely difficult. Right now, the trend has been improving, and that's why the stock market's holding up so well. Now, earnings, if you're a fundamental guy, definitely have to get better to justify the higher prices because the multiple's higher. But right now, people talk about it, but it's not derailing the stock market right now because we're in an uptrend.
So going off of that, Bob, we are at the end of July. What are your thoughts for stocks for the rest of the year?
Well, if you think about what's driving stocks in the first 7 months of the year, number one is lower inflation. That's the most important thing. After that, better than expected economy. The job market is holding up really well. So there you go. Earnings have stabilized, as I said, and the PE has expanded. It's gone up. So we're trading at close to 20 times forward earnings for the S&P. That's a very high amount to pay for a future stream of earnings. So the question is, what's going to drive the market in the next 5 months? So number one, I would say, can earnings ramp up? And can we get a lower PE? That would make a lot of people more comfortable. Other than that, the big question is, can we really get a soft landing, without a recession happening? And I don't know the answer to that. All I know is the people who thought a year ago that a recession was imminent in the second half of 2023 have all been wrong. So this doesn't mean that eventually somebody's going to be right and we'll have some kind of recession. It may be we have a slowdown that's a very mild recession, so mild you could barely call it a recession. The word recession is a little fuzzy, by the way, what it actually means. But that still may happen. I'm sure, 100% sure, we'll see lower levels of economic activity, but not necessarily what we would consider recessionary levels. So again, getting the soft landing right. There are degrees of even of soft landing versus hard landing, which would be a recession, is going to be the main issue for stocks in the next 6 months.
So Bob, our audience obviously loves to hear about your concert posters. Have you been to any good concerts recently?
Yeah, I've been to a few. I saw The Dead in New York a few weeks ago. It's, of course, the last incarnation of the Grateful Dead, and I was pleasantly surprised. I thought I was prepared to be disappointed because these bands are pretty long in the tooth now, and I've been a Grateful Dead fan for 50 years. But I was pleasantly surprised. I thought they were terrific. But Bob Weir played great. I thought the overall band played great. They played songs from the period that I most know them, which is 69 to 75. So I'm playing in the band and China Cat, Sunflower, and songs like that I like Mother's Milk to me. And they just sounded terrific. So they say that this was the final tour. John Mayer tweeted out at the end that he doesn't know, but if this is the final tour, they certainly went out on top, and I really was just delighted to. I walked away from that concert very happy. I saw Bruce Springsteen at the Circus Maximus in Rome, in Italy, a month and a half ago, and that was quite a show. The Circus Maximus is the old chariot racetrack. I mean, the old Ben-Hur, the real one. And it was quite a show. He is it's just an amazing band. They're very intense. The one thing I would point out is this was 40,000 people in a field. And no seats, all standing, and it had rained that day, so it was a bit of a little bit of a muddy mess. I stayed on the sidelines. I'm a little old to go wading into muddy messes, but it was a wonderful show. And I'm going to see Santana shortly, and Carlos Santana is one of the last of the great 60s guitar gods that I think is still really vital. He always puts on a good show. So obviously you're dealing with the guys who's still going to old 60s rock shows here, and these rock gods are, as I said, aging. Some of them better than others. Santana is one of the ones aging better than others.
Well, that sounds like a lot of fun. I'm very jealous that you went to Italy, and it sounds like you had a great trip there. But yeah, great concerts all around.
Yeah, I would. Going to concerts is, in an age of artificial intelligence, going to a live show where musicians are playing, and anything can happen. It could turn into a great set. It could turn into a terrible set. And if you ever talk to musicians and you get them quietly alone, they will tell you there are great nights and there are not so great nights, even playing exactly the same material. There's just nights when people are on, and sometimes when they're not. Music playing is usually an ensemble activity, so a lot can depend upon how the overall band is playing. But imagine being an actor when you're, a major actor in a play, and a lot of it rides on you. Imagine you're doing Hamlet, and the fact is, human beings are humans. They don't feel the same way every night. You don't go. I've always imagined what it must be like to do Hamlet. Imagine that night after night. That's a pretty intense show, and it's largely on you. So you don't feel the same every night, and you yourself would judge your performance differently every night. You'd say I was really on, and then you'd say I just didn't feel it that night. So that's part of the fun of this thing. You're going to watch human beings perform, and it's not perfection. You may want to have your favorite Springsteen songs performed exactly as you remember them, and sometimes they'll deliver on that, sometimes they won't, sometimes they don't want to, but that's all part of the fun of interacting with other human beings. I think it's very important in the age of AI to get out more.
Definitely. Well, hope you have a great time at the Santana concert, and thank you again for answering all of our questions. Thank you to everyone who sent questions in. We always love to see them. And Bob, we'll talk to you again in a couple of weeks.
Thank you, Katie. Thanks, everybody. Have a good weekend.